Hi, this is Drew Tignanelli here with Graham Ewing, and we're talking net unrealized appreciation. Graham, you like my Florida attire?
I do. I do. I need to get a shirt like that.
There you go.
You can
I'm
even
getting
get the consulate logo on it.
I, that would look great, I think, you know?
It
So
would.
this is a strategy, Graham, that probably only a handful of our clients may actually be able to implement. But they probably know, friends and family, that this could be incredibly important. And so few people know about it, but it is an incredibly effective strategy that if you are work with a company that you can do this. But we're going to explain it, right?
We are. And we get excited about taxes, but this takes it to a whole nother level. This is super exciting stuff.
And anytime you can save money on taxes like this, you get really excited about it.
It is. So today, the title, Saving Taxes on Company Stock in Your 401k. We're going to dive deeper there. But as Drew said, the name of this strategy is called net unrealized appreciation. So if you've ever seen this obscure thing in any 401k documents you got, this is something you really want to look into. So we're going to cover who should do this. Drew already touched on that a little bit. We're going to dive a little deeper. We're going to talk about how to do it, and likely something you shouldn't really do at home. And then the why. And we've touched on that a little bit as well about saving taxes, but we're gonna get into the details there. So the first part, who is it for? Anyone who has company stock in their 401k or other qualified plan, right, Drew? So it's not just a 401k, it's anything that's in a qualified plan, such as an employee stock ownership plan.
Right? Or a profit sharing plan.
Or a profit sharing plan. The
Could be.
the other part here is that it is very helpful for, or it works really well for long tenured employees, particularly those that have highly appreciated stock. That is where it benefits the people the most. So if we think about companies, Drew was referring to this earlier. So think of around Baltimore area, McCormick, UPS, Raytheon. These are three companies that we've done it before, and we know, some employees can really benefit from this.
Yep.
So let's dive into the how. This is the meat of the presentation. So let's meet Charlie. Charlie started working in 1993 at UPS. In 2023, he's ready to hang up the towel and he's ready to retire. He's got a 401k with $1 million in it. And in that 401k, he's got $400,000 of UPS stock, $600,000 of other types of investments. So we'll just call it mutual funds. $1 million, 400,000 of which is in UPS stock. But in that UPS stock, we broke it down a little more here, and you can see 200,000 is what for today we'll call the basis. It's different than basis in a normal brokerage account, but for today we'll call it basis. $200,000 is what the original purchase price was of all of that $400,000 of shares. So we've got $200,000 of basis, $200,000 of appreciation, in addition to that $600,000 of mutual fund that we talked about. So option one with this 401k, most of the time, people roll everything into an IRA. But what does that mean? So you roll it into an IRA, that is not a taxable event, moves from a 401k to an IRA, it's like kind taxes, so there's not a taxable event there. When you take the money out of the IRA in the future, let's say you have to take required minimum distributions at age 73, that's when it is taxed in the future. But it is all taxed at ordinary income rates. So you've got that $1 million in there. Every single dollar you take out is at that ordinary income rate. So let's look at that for a second, okay? ordinary rates versus long-term capital gains rates. And I'll explain why we're comparing these two in a second. But the income on the left here, you can see starts at 22,000, goes up to almost 700,000 there. And the ordinary income rates, you can see start at 10% and go up to 37%.
And that's
Now,
just now.
What's that?
That's just now. 2 years from now, that's going up by at least 3, 4, 5%, 2, 3, 4% on each and every one of those.
Exactly. The current tax law sunsets at the end of 2025. So 2026 will have different rates and yes, higher rates, but
all higher, right?
All higher rates. So let's look at this other column, long-term capital gains rates, 0, 15, and 20. And I'm going to stop. Let's just look at this for a second. And you can see for all of those income thresholds on the left, looking at the ordinary rate versus long-term capital gains rate, nearly every single scenario, the long-term capital gains rate is lower than the ordinary income. For anybody that's paying really close to attention to detail there, you can see that there's that 12% bracket that goes up to the 15% bracket. But if you look at the left there, it is only a $200 income increment. 89,250 to 89,450. That $200 of income could get taxed at a 3% higher rate, but it's so small, it doesn't really have an impact at all. So bottom line here, long-term capital gains rates are almost always lower than ordinary income rates. So let's look back at this 401k. So we talked about the mutual funds, 600,000, talked about the basis, and we talked about the appreciation. It is this appreciation, which is the net unrealized appreciation, that is taxed at lower capital gains rates. So now let's get into it. Option 2, this is why we're here, net unrealized appreciation strategy. The way this works is you've got this 401k with these mutual funds of 600,000. You've got the appreciation of 200,000. And you've got the basis of 200,000. Where does this go? How does this work? So the mutual funds, we have to roll over into an IRA. 600,000 mutual funds goes into the IRA, $600,000. But the appreciation and the basis goes into a brokerage account. We're going to talk more details in a second, but it's really important to know that it has to be in kind. You can't liquidate the UPS stock first and then put in the brokerage account. The UPS stock in kind as shares of UPS have to be rolled into a normal taxable brokerage account. So that is step 1, and it's important that that's followed. Step 2 is really all about that $400,000 brokerage account now. You can forget about the $600,000 in mutual funds that's in the IRA. That part is basically done. But the brokerage account, $400,000 now has $200,000 of basis, $200,000 of appreciation. The way this works is the basis has to be rolled back into an IRA. So you think, well, why can't I go just directly to the IRA with this basis? And it doesn't work like that. We're not going to try and understand it. We just need to memorize it. So this basis goes back into the IRA. And you see there, we have 60 days to do that. It's a tight timeline, and you have to get that done in 60 days. The UPS appreciation, that stays in the brokerage account. So Drew, anything else on this before I go to the next?
It's very important that when you roll the bases into the IRA, it's specifically UPS stock that rolls into the IRA. You don't sell 200,000 of UPS stock and then put 200,000 of cash in. Because the UPS stock came out of a qualified plan into the brokerage account, I have 60 days to pick up 200,000 of UPS stock in kind back to the IRA, and then the 200,000 of stock in UPS stays in the brokerage account as the appreciation.
Exactly.
You're good to
Exactly.
go.
So this right here, the whole title of this presentation, net unrealized appreciation, is this UPS stock appreciation. It's that $200,000 that we're really focusing on. So if we look at, again, we're back to the same chart again, ordinary rates versus long-term capital gains rates. We got the income, the ordinary rates, and the long-term capital gains rates. So that 200,000 is what we can now pay long-term capital gain rates on instead of ordinary income rates. But let me clarify something. You don't have to sell the UPS stock in the brokerage account right away. That $200,000 you could leave in there. But if you were to sell it, that's where the capital gains rates come into play.
It's
So let's look at,
important, Graham, to keep in mind that 200,000 of appreciation, any amount you sell 10,000, that's $10,000 capital gain. There's a $0 cost basis in that stock. So if you sell 10,000, it's a capital gain at 10,000. You sell 100,000, it's a capital gain of 100,000.
Exactly. So now let's look at these scenarios, because as Drew is saying, every single dollar of that is a capital gain. But let's see how we can save taxes on this, even beyond what I've already said. So tax type, 3 scenarios here. So the first one, the ordinary rate. Again, let's pretend that scenario, they rolled it all into the IRA, like a normal 401k rollover. The tax rate on that, let's just say, is 22%. It's going to vary depending on your specific situation, but let's say 22% is what we have here. The tax is $44,000 on that. Okay. Now, again, there's some complexities here that I'm trying to strip out and simplify, recognizing that there's marginal rates on how taxes work. But let's say 22% is where all this 200,000 is taxed. The savings, 0. We haven't saved anything, right? That's the normal scenario. Compared to the normal scenario, there's no savings. Number 2, if we just had long-term capital gains rates for that same scenario, that same person who was in the 22% tax rate, for long-term capital gains, they are in the 15% tax bracket. So the tax on that is $30,000, right? So the savings between 44,000 and 30,000 is $14,000. So just those differences, 22%, 15% on this scenario saves $14,000. It's just, and there's nothing to be done. It's just an administrative difference. It's a different strategy, and all you have to do is know about it and do it the correct way, and you saved yourself $14,000. That is really cool. The last one, it gets even better. Can you believe, Drew, it gets even better?
It does.
It does. So let's pretend that Charlie was going to retire, right? He's 65 years old. He's going to retire. He doesn't have to take money out of his IRAs or anything like that. And he just needs some money to live on. So we say, hey, Charlie, let's take that $200,000 of UPS stock that's in that brokerage account. And in year 1, let's sell $100,000 of it. And that's the only income on the tax return. Well, guess what? All of that, because there'd be a standard deduction that gets you down below roughly 80, 90,000, to 80,000, even less of taxable income, that entire capital gain would be taxed at 0%. We're talking federal right now, not state, but 0% on the federal. 0% times 100,000, $0. So you do that in year 1, $100,000, year 2, another $100,000. You have sold that entire $200,000, paying 0% in long-term capital gains rate, and you've saved yourself $44,000. So just think about this. You put the money into the 401k. It could be money. And one side note here, you could put the UPS stock in there. You could have bought it yourself, or it could have been a match from the company. It doesn't matter how the UPS got into the 401k. As long as that got in there, it was pre-tax. And then you've been able to take it out this way without paying tax on it. You have completely avoided the federal tax on this money in a legal way. and that's the important part, in the legal way. $44,000 there.
I mean, you know, Graham, there are so many benefits to NUA when you do it right and you know how to do it. Very few people are familiar with it as well as they should be that are in the advisory business.
Right.
But somebody under the age of 60 leaving a company and they have appreciated stock in their 401k, profit sharing, or ESOP, that's a great chance to get money that you can get a hold of, because when you roll that basis back in, there's no penalty for, you know, taking the appreciation out of the 401k.
Right.
Also, you get somebody who's charitably minded, and you get a lot of, let's just use the UPS. So you got 200,000 of UPS at a 0% cost basis. They're charitably minded, and they give $20,000 a year to their charity because they have a lot more income. They can't get down to your 0% bracket, but they put that 20,000 into a donor advised fund, which is what they give away charitably. They get a full deduction for the $20,000. I mean, it doesn't get better than that, Graham.
Just the same as if they had given cash.
Yeah, just the same as, and yet they not only didn't have to pay tax on the appreciation, but they get a $20,000 additional tax deduction. It's just, there's so many good things about NUA that if you know about it, you know how to do it right. There are a lot of key issues. You're not even really going through a lot of how to do this, as you know, because it's not something you want to try to do yourself, you know, as they say.
Something you want to do by yourself. And these, to an attempt to try and give you some of the details, I've put the top 4 in here. So number 1, it has to be a lump sum distribution. So we talked about that $1 million in the 401k. That entire $1 million has to come out of the 401k all in one calendar year. If you don't, let's say you just took out the UPS stock and you left the mutual funds in there, disqualifies the entire thing, blows it up completely. So lump sum distribution is really important to remember. The other thing we touched on already is the stock has to be distributed in kind. The UPS stock has to go into that brokerage account in kind, meaning as shares of UPS. It cannot be cash that gets rolled into the brokerage account. And like Drew said, when you take that basis of the UPS stock and roll it back into the IRA, that also has to be in kind, meaning shares of UPS stock, not cash. The third one is that this cannot be done until there is a triggering event. So the 2 main ones are you've separated service from a company, or you have reached age 59 and a half. This is, and there's something really important to understand about this, is that there is the law, the tax law, and then there is the 401k plan document. And the plan document is more or less going to override, you know, any of the laws. So the plan can be even more specific than the law can. So it's really important that you know the details of your specific 401k plan.
Yeah.
Yeah.
Go ahead. No, go ahead.
And the last one, which we've talked about already as well, is that basis. When you roll it back into the IRA from the brokerage account, it has to be done in 60 days, in kind and in 60 days. It's really critical that it's done in that time frame.
Yeah, so it's also important to keep in mind, Graham, that just because your company does have company stock in their 401k that you've been buying and it's highly appreciated, there's always a possibility that that company does not allow NUA. It doesn't allow you to keep the company stock. And if it doesn't allow you to keep the company stock in a distribution, you can't do NUA, even though you were investing in company stock. Now, I don't know why companies do that, but there are a handful out there that are like that. I've run into them in my career.
Right. So circling back one more time, this is the third time, just showing you why we're doing this. The ordinary rates of a normal distribution from a 401k are higher than long-term capital gains rates. This is the whole thing. If you want to remember one slide, this is it. This is why we're doing it. for those long-term capital gains rates. And as we said already, we are trying to make this as simple as possible. We're trying to not have you drink out of a fire hose. And so if you have any other questions and you're already a client, we would suggest you reach out to your primary advisor. If you're not a client already and you're interested in becoming one, you can go to our website, financialconsulate.com, or you've probably seen that little scan me button on the right side. You can take your phone, take the camera, and have it look over that QR code, and it will bring up an ability to schedule an intro meeting with us. So this is, again, already a client, reach out to their primary advisor. If you're interested in becoming one, go to our website or scan that QR code there. And if for some reason you're watching this webinar and this has nothing to do with you, you don't even have a 401k, but you know friends who work at McCormick, who work at UPS, who work at Raytheon, share this with them. We want to save that $44,000 in that scenario. This is something that most people, as Drew said, don't really understand. And it's something we really, really think can benefit a lot of people.
I did my first NUA distribution with Procter & Gamble back in 1985 or something like that. So I've been dealing with this for many years. And you're right, you didn't give them a fire hose to drink out of, because just that one little phrase, Graham, lump sum distribution, is a lot more complicated than you made it out to be.
Right.
You said it correctly, but you simplified it greatly as to what a lump sum distribution is. And you know, if you try to do this, even with somebody who says, oh yeah, you know, I could do this, and they don't really understand, you make a mistake, you're going to pay taxes on $400,000 at ordinary income tax rates, Graham.
Right. So we thank you for attending today. Hope you learned something, and that, yes, you weren't drinking from a fire hose, and we look forward to seeing you next time.